How to double your money using the rule of 72. A rule like the rule of 72 was considered more significant by Albert Einstein than his theory of relativity. Its origin is attributed to Luca Pacioli, known as the father of accounting. This rule is discussed in his 1494 book Summa of Arithmetic, Geometria, Proportion and Proportionality. In just a few short years, everyone would like to double their money. Have you ever wished upon a falling star that you would be able to wake up tomorrow with 6 figures? Well, I'm here to tell you that it is possible. This is not a fantasy. In today's video, I will discuss the rule of 72, so stick around, you don't want to miss it. Number 1. The rule of 72. The rule of 72 is a tool that can be used in various aspects of financial planning and decision-making, including setting goals, analyzing economic trends, evaluating investments, and managing debt. It is a way to estimate the length of time it will take for an investment to double in value given a fixed annual rate of return. To use the rule, you divide 72 by the expected rate of return. For example, if you expect to earn an interest rate of 5%, you would divide 72 by 5 to get an estimate of how long it will take for your investment to double. The rule is useful for getting a rough idea of how an investment may grow, but it can be limited in its accuracy, especially for rates below or above certain thresholds. It is always a good idea to consult with a financial advisor for more in-depth guidance. Number 2. Compound interest. The rule of 72 is specifically designed to work with compound interest, which is a type of interest that is calculated on the initial principal of an investment as well as any accumulated interest. This means that the longer you leave your money invested, the more it will grow due to the compounding effect of the interest. To use the rule of 72 to estimate how long it will take to double your savings, you simply divide 72 by the annual interest rate you're earning. For example, if you're earning an interest rate of 6%, it would take approximately 12 years for your savings to double. It is important to note that the higher the interest rate, the faster your money will grow. If you want to maximize the growth of your savings, it can be helpful to speak with a financial advisor and explore options for high-yield compound interest investments. Number 3. Investments. The rule of 72 can be a useful tool for evaluating potential investments and estimating how long it may take for them to double in value. To use the rule, you simply divide 72 by the annual rate of return that the investment is expected to provide. For example, if you're considering an investment that is expected to return 1% per year, it would take approximately 72 years for your investment to double in value. On the other hand, if you're considering an investment with a higher expected return of 12% per year, it would take approximately 6 years for your investment to double. Using the rule of 72 in conjunction with the concept of compound interest, you can compare the potential growth of different investments and make informed decisions about where to allocate your money. It is important to keep in mind that the rule of 72 is not a precise calculation and can be affected by other factors such as fees, taxes, and inflation. It is always a good idea to do a thorough research and consult with a financial advisor before making any investment decisions. Number 4. Inflation rate. Inflation has been mentioned a lot lately, but what exactly does it mean? Inflation is a measure of how much the prices of goods and services tend to increase over time. When inflation is high, it means that it takes more money to buy the same things that you could have bought in the past. The rule of 72 can be used to estimate how long it will take for the price of something to double, given a certain rate of inflation. For example, if the inflation rate is 3% per year, you can use the rule of 72 to calculate that it will take approximately 24 years for the price of something to double. On the other hand, if the inflation rate is higher, such as 6.8% per year, the price of something will double in a shorter amount of time, in this case approximately 10.6 years. By using the rule of 72 to understand the potential impact of inflation, you can make better informed financial decisions and plan ahead to stay ahead of the curve. Number 5. Savings. This rule can be helpful in a variety of financial planning and decision-making contexts, including when it comes to saving and investing. When you understand the rule and how it works, you can use it to project how long it may take for your savings to double in value, given a certain rate of return. This can be useful when considering where to keep your savings, as different options may have different potential returns. For example, keeping your savings at home may be risky and may not provide any return. However, investing in the stock market may offer the potential for higher returns, but also carries a higher level of risk. On the other hand, opening a savings account at the bank may offer a relatively low but stable rate of return. By using this rule to understand the potential growth of your savings, you can make more informed decisions about how to allocate your money. Let's now look at some examples using this rule. 72 divided by the rate of return equals the time for the investment to double. For example, let's say you want to save $1,000 in the bank. Then let's say you receive 1% interest on the money you save. 72 divided by 1 equals 72 years. In 72 years, you will have $2,000 if you put in $1,000 today. It's unlikely that you will be around to make a $1,000 profit in 72 years. Many investment programs offer a minimum interest rate of 4 to 7% per year. Just do some research, sit down with your financial advisor, and you'll be able to figure out a better way to invest. Now let's return to the $1,000 example. Using the same $1,000, you now invested in an index that guarantees an interest rate of 5% per year. Therefore, 72 divided by 5 equals 14.5 years. It will only take you 14.5 years to double your investment instead of 72. What's more, it's safe. 5% is just an example. Realistic rates can be higher. Overall, the rule of 72 is a simple mathematical calculation that can be used in a variety of financial contexts in order to calculate how long it will take an investment to double, the effects of compound interest on loans or debts, the impact of inflation on money's purchasing power, or the length of time it will take for an investment to reach a certain value. Using the rule can help you make more informed financial decisions, but it is critical to keep in mind that it is not a precise calculation and can be affected by other factors such as fees, taxes, and inflation. It is always a smart idea to do thorough research and consult with a financial advisor before making any financial decisions. The key takeaway from the rule of 72 is the importance of patience and planning in achieving financial success. That being said, have a great day, and I will see you all in the next video.